using options data to try to predict what is going to happen to the stock, whether the stock is going to be range bound or there is a trend, uptrend or downtrend in the stock. Options is an important instrument specifically for those stocks where options is very liquid, because a lot of players, because of cost effectiveness, because of good money management, a lot of players, they use options as a mean to trade the market or take positions in the market. This data point, or the data points available for so many stock options, if analyzed properly, we can make two smart judgments about those stocks. One is the max pain or the range theory. What is the max pain or the range theory? Option open interest gives an indication of what is expected range of the market or stock for that given expiry. Since an American option is exercisable anytime, the buyer has an advantage, right? Because as a buyer of an American option, I can exercise any time of the day, anytime before the expiry, right? Since the European option is exercisable only at the time of expiry, the seller has an advantage. What does this mean? In Indian market, options are European. That means the seller of options has advantage over the buyers. This is very, very critical. That sellers always will have a larger say in case of options in Indian market because of its European nature. Thus, any major build-up in OI could be safely assumed to be the build-up from the seller of a specific options contract. So, if on a specific strike price, there is a significant build-up in the open interest, that means seller who believes that the market will respect that level of that stock has agreed to sell options to the buyer and earn premium out of that selling. So the seller is a confident person, and he would, by the virtue of that confidence, he would like to defend that price of the underlying, otherwise the seller will start incurring significant loss in that trade. So max pain from that logic is the expected range of the market or stock based on the open interest data of the strikes. Now let me go to NSE website and let us try to see the max pain theory. So let us go to live data and see equity derivatives and see option chain. Now in Nifty option chain for December expiry, if you see the maximum open interest in the strike price standing in case of call is here, which is 8,300 call, and in case of put it's here, which is 8,200 put. What does that mean? That clearly means that market is expecting the Nifty to expire around 8,300, between 8,300 to 8,200, because a lot of option seller have sold put of 8,200, so that means they don't expect market to go down, and they have also sold call at 8,300, that means they don't expect market to go up beyond that. Also, if you see the change in open interest today, in this call there has been significant change in open interest, right? And in case of this put, where is the put? 8,000. In case of this put, open interest, the maximum open interest is at 8,000 level, and the second maximum is at 8,200 level. So there has been slight reduction in open interest in put today because market has gone down, and there has been aggressive increase in open interest of 8,300 call today because market has gone down. That means 8,300 will supposed to be a very, very critical resistance for the market for this expiry. So this thought process of identifying the range of an index or a stock will give a range for a given expiry, but in case of any major change in open interest at the end of the day or towards the end of the week, the thought process will change, the range outlook will change. How do you take advantage of that range? So if technically you also see market at a resistance level, and you also know that a lot of people have sold 8,300 call as well as 8,200 call. So basically you get a confidence, you get a success, you get a probability that there are other people who also believe that yes, market is going for some kind of an uptrend. Now to gauge market on a day-to-day level, if you track put call ratio as well, this will give you again an understanding of the level of position which is changing on a day-to-day basis. So put call ratio is basically the total outstanding position in put for a given strike price divided by total outstanding position in a call for a given strike price. So if put call ratio is going up, that means people are selling more put, that means they believe market will go up. If put call ratio is going down, that means people are selling more call, that means they believe market is going to go down. If you track put call ratio on daily basis, even on a real time basis, you will be able to get an indicative idea about where the bigger guys who have significant positions in the options are parking their positions in. And based on their positions, it's a presumption that they will make sure they will try to defend their position by defending a level of that instrument or the underlying. So for an overall trend analytics and as a support to your overall view in the market, put call ratio or options open interest data is a decent support for your overall view in the market or in the stock. So this was overall the derivative analytics module where we have introduced you to the concept, the data points which can be used to make a lot of sense about what's happening in the market. So this was keeping equity in mind, but in case of commodities, you can add more data points. You can add the exchange warehouse data points as part of derivative analytics and see whether the delivery of the commodity is getting increased in the exchange or getting reduced in the exchange or not. You can also add global market data as part of commodities because a lot of commodities are traded globally in LME, in CME. And you can club that data with the Indian data to arrive at the macro price expectation of that commodity. You can also add the spot market data, which is a very, very difficult task to source from. But if you build a good intelligence network in the spot market of that commodity, you can add that spot market data for your understanding so that any major effect on the parameters of spot market will have an immediate impact on the futures as well, and you can act better and faster than any other people in the market. However, let me throw a caveat for the last time that derivative analytics cannot be a sole way to come out with a trading idea. It's a great support, but the trading idea has to have technicals as a primary mode or market intelligence in the form of fundamental, and derivative can be a great support to your idea and it can increase the probability of your success in trades. Also, derivative will help you to filter all the ideas and you will reduce number of trades in the market and try to focus more on right trades rather than just increasing the number of trades in the market. I wish you best of luck for your future trading activities, and in case you have any query with respect to derivative analytics, we'll be happy to help you. Do send us an email, do send us your Excel sheet which you have made, and we'll be very, very happy to help you in this endeavor. Thank you for attending this program.